while your margins have been going up in the last 2 to 3 quarters, what is the targeted range going forward? And I ask this because there will be, of course, eventual headwinds on account of talent, discretionary spreads as well, or other spends going forward.
So from our perspective, look, on one side, the market demand is pretty robust, and the market demand being robust, and this is a trend that is being seen by the customers as well. So we have a pretty good position when it comes to signing newer contracts or renewing the earlier contracts with a pricing, advantage over the earlier pricing. So there's a pricing that is, putting us in a positive side of the house. The demand is on the positive side of the house. Obviously, there's pressure on talent. There would be things like attrition, etc., that would be on the other side. But overall, we expect this to get balanced out, and we expect the margins to remain stable for companies like us, adjusted for any acquisitions that we might do where we may have to take amortization. So from our perspective, there are puts and takes, and we are working to make sure that the margins remain in the band that they are.
Mr. Gupta, Lloyds has seen a decline in growth this particular quarter. What can we expect in Q4 since the summer season is around the corner, and whether or not you are seeing early demand trends actually look up?
As far as Lloyd is concerned, it's I think if you look at the 2-year CAGR, it's very healthy. It's over 25%, and so that is an indication that the last year base was a high base due to many factors. As far as seasonal demand is concerned, we are definitely expecting a very good summer this time, given the fact that COVID had hit both in 2020 and 21 during the peak season time. So we are expecting not only a pent-up demand, but a good demand coming in the summer season. The initial trends are still a bit slow, as I said. Second half of December, January, because of the third wave, things have been slow, but we are expecting things to start coming back to normal levels in February and March.
Now, I was flagging off that your margins this time around have come in a little bit lower than what the guided range was, 15.5% thereabouts to 17%. What has led to the margin pressure this quarter, and do you think that margins will continue to linger at these levels? What do you think will be the sustainable run rate for your margins going forward, given the fact that there are headwinds when it comes to talent as well as discretionary expenses?
I don't think it's a miss per se, because last quarter we closed an acquisition of Blink where we called out for a 80 to 100 bips impact purely based on the acquisition for amortization and bonus purposes that we are actually amortizing over the next 2 years. So if you look at an organic basis, we are actually well within the band of around 16, 15.5 to 17. We are right around 16 plus if you add back the 100 bips that we called out for last quarter. So we didn't change the band on an organic basis. We're still maintaining it. The other thing that we should also call out is this quarter we also had an allocation of ESOPs and RSUs as per the AGM approval that happened in September, and we've actually assumed another expense this quarter, but we managed to maintain that through operating efficiencies. So I think on the margin front, sustainability of organic operating margin in the band will continue to be our focus, and while driving for growth, we actually have managed to maintain margins.